let's go through Morningstar and how to pick your funds. And I want to start with, before you there, you need to know your time frame. You need to know what you're actually looking for. Some funds are better for a short-term time frame and others for a long-term time frame. And the way we look at it is this: cash equivalents, CDs are on the bottom. Bonds are in the middle, starting with U.S. government bonds that are backed by the full faith and credit of the U.S. government. And then we go up to other government bonds and then corporate bonds. And corporate bonds get rated the same way that you and I get a credit rating. Corporate bonds get rated. Everything from investment grade bonds to just general bond funds to what are junk bonds. So if something's called a high yield fund, or if it's called a junk bond fund, that will be still than most stock funds, but is the highest risk bond fund that you can buy. Then when it comes to companies, they're at stocks, they're further up the pyramid. You'll have large companies, large, very, very safe, very value-oriented companies. We'll get into that a little bit. All the way up to mid-sized companies, then small companies, right? International will be kind of the same way. International big companies, international medium. And you also look at the countries, international established countries, international big markets, or smaller economies will then riskier. So the further up that you go, the more time you want to give it. Internet is a horrible place to be if you need the money tomorrow. International stocks are a great place to be if you've got 15 to 20 years. That's not you. But when you're looking at your fund, you kind of want to know it's the time frame. And that is where we start. That's kind of outside the scope of this. I'm going to show you a little bit using Morningstar how to look at that. However, you're going to want to get ingrained what the different time, which investments meet the different time frames. So Aaron asked a question. It's a great place to start. Before we get there, what I would love to do, if you'd like to take out your actual funds, and not to put on the screen or share with us because we don't have that ability here, but somebody would like to share an actual fund that maybe they have available in their 401k or that they've invested in, think about invested in. Here's what I would like. I would like it to be an actively managed fund. I would like it not to be an exchange traded fund for both the difference between. So I would like it to be just a regular mutual fund that maybe you find in your 401k. If you just give me a name, I will show you using your fund versus using one that I pre-picked. All right. Just to show you that you can do this with any fund. And we can take a few of these as we go. Hey, Mayo, there's Amar there. But I want to start with what Aaron asks here. Difference between free and paid versions. So at this point, let's go to Morningstar. And we're going to have this on a lot. This is the front page of Morningstar right here. And you'll see up in the upper, they make you sign in to have an account. The good news about signing in is you don't have to pay for anything to get an account, and I fully recommend doing it. I have an account I don't pay Morningstar for that account. I don't do any of the paid stuff that Morningstar has. You can do it. However, everything we talk about today is absolutely free. It also, and I want to make this clear, this is why people like OG and I love Morningstar, and most financial advisors, frankly, like Morningstar, is because of the fact that Morningstar, while they will have ads on the site, Morningstar has done a phenomenal job of keeping the advertising side and the editorial side separate. So when Christine Benz is an example, who's a wonderful woman at Morningstar. She's been on our show a couple times. When Christine Benz says something, it is not beholden to Vanguard, to Fidelity, to Putnam, to Oppenheimer, to any of the big fund companies. She can say whatever the heck she wants to say. And I absolutely love that. So they do a fantastic job there. All right, Malcolm, TRSAX, in just a second, we'll pull that up. The paid version gets you some additional stuff, Aaron, to keep this easy, that frankly, most of us don't need. Even when I was an advisor and I had the slate of professional based tools, which are of even the paid version, they have an advisor suite of tools. I spent 99% of my time on the free site, because the free site gives you everything that you could possibly need. Now, if you want to keep your portfolio together in Morningstar, that's part of the version. Also, the big thing I don't like about the one is they also have their analyst rating. Hear me loud and clear. I don't really care what analysts think. I don't want to bet on an analyst. I don't want to bet on any of that. I don't want those opinions. I just want the numbers, because the numbers you're going to see tonight tell you a story that is going to be good enough for actually what you have today. Okay, Rocky's got one too. Eileen's got one. Okay, I think that's going to be enough. But so let's start off here with the front page, guys. On the front page, Morningstar, you will see the big thing that Morningstar does is they have something called a style box. And the style box is really important to understand, and is this box that's right in the center top that you see that's all red. Now that shows how different types of investments did today on that particular style. And you'll see that it's like a Rubik's Cube, and it's divided in 3 different areas. So across, if we just go across on the top, and by the way, there's a style box for stocks. There's a different style box for bonds. So first thing is to know which style box you're looking at. This is for the U.S. stock market. U.S. stock market, if you cross, that's large companies. You will see that because of the fact that that upper left sector did the best, it's not hot red, that you were safest today if you had large company stocks. You have company stocks, it's a little bit more crimson there, 2 out of the 3. You were less safe. And of course, if you were in smaller companies, or if you were in the bottom there, you got hammered. So the top, all 3 of those sectors across the top, those are large cap. Now they're going to say large cap a lot. When I was beginning at this, the word cap confused the hell out of me. I mean, it completely did. I'm like, what large cap? What's large cap, small cap? Like, we use this jargon. You know what? Forget all that. Large company, mid-sized company, small company. That's all you got to need. No, the top line is large company. Mid-sized line or middle line is medium-sized companies. The third line, the bottom line, is small companies. Small companies got hammered. Mid-sized companies did a little bit better. Large companies did even better. Left to right, that one that did the best, that goes down, the left column going down is value. The right column is growth. The middle column is a blend of the two. What's the difference between growth and value? Let's say that, we're about to use Malcolm's fund we're going to look at, so I'm going to pick on Malcolm. Let's say Malcolm and I are looking at funds together, and he's a growth investor and I'm a value investor. And we're looking at Morningstar, let's say, as a company, and we're evaluating whether we want to buy this company. And you know if Morningstar is public or not. Does anybody know? I don't know. But when we're dissecting Morningstar, if he is a growth investor, he is looking at how much of the universe they're going to take over next year. What is their growth rate as a company? How many more subscribers they got? How many more people using the site? What's the chance of future growth? Can they expand into future markets? He's asking all the growth-oriented questions. The good news about growth companies is when things go really well, growth companies will go up faster because they're poised for it. They are ready for it. The bad news about growth is they will go down faster. So if you are investing on the right side of that Rubik's Cube, you're asking for more of a roller coaster ride. And as you go to mid-size and to small, you know where I'm going here. The roller coaster ride is going to get bigger. And I'm going to show you that roller coaster ride for the specific funds that we look at. But generally, that lower right cube of that Rubik's Cube is a hell of a lot bumpier ride than the upper left, because the upper left is value. And what value investors look at is this. I'm not looking at the growth. I'm not looking at where the company's going. I'm asking this. If I sold this company for parts and it's trading at $20 a share, and I think parts are worth 30. Well, I've got, when I was a kid, Kmart was big and they had that Kmart blue light special. I got a special. I have a deal. I found a deal. And I am going to buy this based on the fact that it's undervalued. That's much more of a Warren Buffett approach, right? Value, how much value is in there. So left is value, and right, value companies will generally go up and down a little less. Growth companies will go up and down more. Now, what's cool about this, the more that you know, just to nerd out for a second, is that even inside of these style boxes, let's say you're in that upper right quadrant, some companies are going to have mega big companies in there, and other ones will have small, big companies. Follow me? Those ones are mid. So even in there, when you compare two, you can start getting really granular. When I was an advisor, I got really granular on exactly what I was seeing. And as you went through and parsed the data, you could see exactly why one performed better than another. Because usually your fund is going to go where the market goes. And most days, your fund's going to go where the market goes. All right. So let's take a look at what Malcolm gave me here. TRSAX. All right. So when I pull up SAX, you will see that it gives me the fund right there. The cool thing is I don't have to know the fund. Let's say that I wanted Fidelity Contra Fund. I don't know what it is, but I just know the names. So if you don't have the like he did, I noticed that who gave me that? Mario gave me Fidelity Advisor Equity Growth. So let's put that in Fidelity. Whoops. This is interesting. It doesn't come up. So I'm going to go to Fidelity Advisor, and I got a bunch of them. Nope. Now, Fidelity Advisor is a ton of different funds. That's weird. It's only giving me a few. Generally, it's going to give me a full list. I need to keep reading. All right, we're looking for Fidelity Advisor equity growth, and notice there's just a ton of results. So now I'm just gonna scroll through here. But what you'll see there's class Z. Just as a difference between M and Z, what is this spaghetti lettering at the end? ZM. Those are the fees that you're paying. So different funds have different fee structures. If you're really just looking to see what the manager's doing, who cares? In this case, we want to know everything about it. I am not seeing that one. So let's just go into M for now. If you don't know exactly what it is, yeah, Gary, your 401k does not show tickers only funds. You do what I did. And if it shows you the fund, do the one that is, they're all going to be very close to the same. The fee information may not be right. So you might have to ask your provider exactly what the fee information, exactly what the fee is, which class of fund that you have. Let's go back to Malcolm's though, because he's the first one to answer me. TRSAX. All right. And if you do have the ticker, makes it super easy because there it is. Whoops. Okay. Most people look at one thing here. I'm going to for just a second. But you guys tell me what is the first thing your eye goes to here? Because most of our eyes go to the same thing. Anybody? I know there's a slight delay, so I'm waiting here. Yes, Tina's got it. 2 stars. Yep, 2 stars. First thing people look at is always the star rating. The thing about picking investments is that most people look at that star rating first. That is the last thing to look at. Now, don't get me wrong, we're going to get there to why Malcolm's fund is 2 stars, but we don't start there. And here's the reason why. If I see a 5-star fund, I assume that's a great, and tons of investors do that when they're going through all of their 4K funds. And certainly, Doom, if you want to invest all money in VTI or VTSAX, you can do that. But that's not really what we're talking about here, is it? We're talking about from what's available, like in your 401k, we're diving into exactly how to evaluate those funds. So if you evaluate and by the way, we're also talking about if you've graduated, you get to the point that your portfolio is big enough that you are losing the same returns that you lose by excess fees or that you lose through excess tax. If your asset allocation is sloppy because you have so much money in VTSAX and you never graduated, I don't understand that. Like, I just don't understand giving up money. I don't get it. So it is truly a way to get there. I love that it takes away all this stuff that scares the hell out of beginners. But I hate the fact that there are people that are analytical about every little thing, except when it comes to doing the right thing with their portfolio. I have no idea why otherwise smart people go, you know what? I'm on the Mayflower. I made it to the New World, and I'm just going to stand here and not get off. It doesn't compute. But this fund clearly is probably not what we're looking for. But what I'm not looking at is that 2-star fund ranking. I need to know why. If I do get the ranking, I want to know why the fund has that ranking. Because on a scale of 1 to 5 stars, 5 is the highest, so much money every year pours into 5-star funds. And historically, 5-star funds have difficulty maintaining that 5-star rating because so much money pours into them, especially if that fund has a manager. Fund has a manager attached, it's going to have a really difficult time. So I don't look at the star ranking. Now, what I want to do, and if you went to my site down here, compare, you'll see the first thing I want to know is, am I going to get hosed this fund? And I'm not looking at fees first. Fees are very important. The first thing I'm looking at is volatility. Is this fund going to mess up my day, right? Is this fund is it appropriate for my goals? Can I stand the risk? Because the biggest problem too is not even your fund. The biggest problem is you, that you're going to bail on the fund and you're going to bail on the strategy before you need the money. So if you don't understand the volatility that you're getting into with this fund, you are hosed ahead of time, no matter how great a fund it is, right? I mean, the best index funds have posted eye-popping returns the past 10 years. If you look at what the average investor's done the past 10 years, they've done nowhere near that. You know why? Because we screw ourselves. Because we jump in, we jump out. We don't understand our volatility stuff. That's why we start there. So once I have that open, you will see across the top here, it says quote charts, fund analysis, performance, sustainability, risk. The very first thing I'm going to go to is risk. And on the podcast, if you listen to the podcast, you already heard me talk about this. But on the podcast, it's funny how much this is like poker players. Poker players are doing something that's incredible. And yet when you talk to a player, all they talk about is risk, right? How do I make sure that, because winning poker players, thing they do is cover their downside. They know what the statistical chances of them reaching their goal. And that's why we come here first. All right. Enough rant. I'm ranting, man. I'm going. All right. So when we look at these volatility measures, I want to draw your line. We have alpha, beta, R-squared, Sharpe ratio, and standard deviation. Those are over in the upper right of all of these charts. We're going to look at a couple of them on the upper right, and then we're going to look at left. Okay. So on the upper right, and by the way, when we do this, that's going to make it so we don't have to just look at the upper left. The upper left, by the way, is kind of an amalgamation of all this stuff. It says that Malcolm's choice here has above average risk and below average returns when compared to its category. Well, there you have it. It takes more risk than the average one does, and it doesn't even pay like the average one does. Matt would be better off with just the index because you get average than having this particular fund. But let's go to the, so to understand these, I want to go all the way to the bottom, and the bottom is standard deviation. Now the standard deviation, and guys, if you're super nerd here and you know how this works, I'm just going to try to keep it easy for people. Standard deviation means that most of the time, this fund is going to do plus or minus whatever that number is from its average. So if I'm looking at an average of 8% for this fund, then it's going to wiggle either down this number or up this number. And take a look at this. The standard deviation on this fund is 24.3. So that means this fund could go up 24% in an average year, and it will be a standard year. You're not rocking. It could go down 24%, meaning let's pretend the average is 8. If we think the average is 8, and we'll get there. I actually have to switch. I have to click over to see what the averages are, and I'll circle back to that. But let's say that it's 8%. If the average is 8 and the standard deviation is 24, that means I'm looking at, in most years, once again, just to keep it simple, that I'm looking at it going down 24 from 8 or up 24 from 8, right? So if my fund does 32%, it's what it's supposed to do. If this fund loses 16%, right? This 16%, it still is okay. It still is in the norm. A lot of people panic when your fund reaches minus 15, minus 16. This fund's sucking. It's doing what it does, doing exactly what it does. So I like knowing that. I like knowing what the supposed to ride is for my fund. Now it says versus the category. What's interesting is when I moved over from being a financial planner, 13, 14 years ago, over to financial media, that it was a weird. Advisors look at the category in terms of the box. What do we do in financial media and when managerial money land? We compare everything to the S&P 500 or compare everything to the NASDAQ. It doesn't compare to the NASDAQ or the S&P 500. If I have all companies, I'm going to be wildly different. If I have international companies, it's going to be wildly different. I've talked to so many people that go, my international fund's underperforming the S&P 500. Yes. And in other years, it's going to do way better. You know why? It's invested in completely different stuff. So know what category we're talking about when it comes here. And you'll see that's in the fine print on right below the chart. It says category large growth. So going back to that style box we looked at, that Rubik's Cube, that's the upper right. Large growth-oriented companies. And what's cool, there's another page on here that shows you exactly what many of those companies would be, what companies would be representative of that. So now we know we can do that a different way, by the way. If we go up to beta, beta's the second thing. I really like beta. Beta is when compared to the market, how much risk does this take versus the things it competes against. So what I really like about this is that the beta will tell me just swing versus 100. So a beta of 1 means it's going to take the same amount of risk, and you should expect it to take the same amount of risk. A beta of 1.1, once again, Uber nerds, I'm keeping it as simple as I can, just so that people lock on. If you want more than this, you can dive in and get the exact things that these do. But a beta of 1.1, just for beginners, 10% more than 1. So if it's 1.1, you're taking 10%. You can expect the management team and this fund takes 10% more risk. If it's 0.9, the fund takes less risk than the market does. If you just know those two things, the deviation, how much up and down is it going to, and then you also know the lock, the beta of does it take more or less? You got so you will see if we dive into that for Malcolm's fund, this fund has a standard deviation of 24. The category has a standard deviation on average. So the average fund it competes of 23.37. The index, which is the Morningstar US Broad Growth Index, so it's growth-oriented large company, 23.79. So what does that tell me? The average fund takes less risk than the index. This one takes more. The beta is 1.08, takes about 8% more risk. The category takes about 5% more risk than the index does. So now we know a little bit about the volatility. If we go down to the chart, let's go to the lower left there, the risk return chart. The red box. So let me explain that going north-south, we have returns from 34% on the top to -14. And then we have from left to right, we have a standard deviation of 14 to 34. And we look at all the stuff we just saw graphically. So when it comes to risk return, the blue represents this fund. You can see it takes a little more risk and it gets a lot lower return versus the category, which stays much closer to the index. So in this case, Malcolm, when it comes to purchasing this fund, so far the fund, you can see why it's a 2-star fund. Fund takes more risk than it needs to than the index. But you have to come to this knowing that large growth companies is what you want in your portfolio. You start from there. All right. Good stuff. Do my 401k is a mix of 3 funds: Vanguard 500 Index Trust, Vanguard Institutional Total National Stock Market, and Vanguard. Doom, that is fantastic, by the way. That makes your job super easy because you just have large cap. And frankly, you don't need a lot of funds. You have cap, low cost. You have international, large cost. And you have small company, low cost. So I love the choices that your 401k made for you. Kept it low cost, kept it simple, kept with the index. Unfortunately, as we see with what Malcolm gave us, not the same for everybody. Let's run this through one more person's here. Let's look at Eileen's DFUX. This is interesting. So this is a DFA fund. And you will see now what we're looking at with DFA over to risk. What we're looking at with DFA, we're looking at short-term bonds. So short-term bonds, again, Eileen, because, we go from that risk word we were talking about. This is not a good fund for a long-term investor unless, and I know DFA to know it's probably part of a design portfolio. This is one of your funds in the portfolio, unless it's part of an overall asset allocation. This will be the first money that you go to because of the fact that it's not going to get in a lot of trouble. And in fact, you can see that when you look at these numbers. These are short duration bonds. So by short ones, it's like a mortgage. A 15-year mortgage is a shorter duration mortgage than a. So when I have short duration versus longer, short duration means it's going to be a short time you get your money back. Generally, by the way, a lot of times short duration is going to be a couple of weeks, maybe a month. Sometimes the Fed trades these hyper short securities back and forth between banks. That's what the Fed really controls. So for yours, this is going to be a stabilizing part of your portfolio. And again, if you're a conservative investor, might be a little bit of a portfolio that was put together that stabilizes some of that up down that some of the more aggressive things do. And it's not about the fund, it's about you. So this fund has a standard deviation of 2.49. It's only going to deviate 2.5% versus the one we just looked at for Malcolm, which is what, 24%? So you can see already, this is a much more safe fund to put your money in if you need over short time frame. Because man, this isn't going to move hardly at all. The category 3.6, so it's even safer than the category is. The beta, remember I said beta of 1 is 100%. Well, this is beta 0.4. So roughly, this is not exactly a beta of 60% less risk than what the index takes. This is incredibly conservative, and you can see that on the risk reward analysis. The red dot shows what the index does, and then take a look. Your fund down a little bit lower return, but and also has a lower return, and also takes more risk than the index, versus the other funds it competes against takes a lot less risk. And as expected, I get a lower. So a little worry there. The fact that it's lower return than what the index does. But on a short-term extended quality, I'm not as worried about it as I would be for Malcolm, which is why in my brain, this would also be justify the 3-star ranking. It's okay. This is not going to hurt you. It's not going to help you. This is going to be a straightforward play. All right, Doom, I'm going to get to, I'll get to the target date fund question when I finish this, if that's all right, because target date funds are a whole different bust. I will give you the short term, because I said I'd rather talk about what you guys want to talk about. I hate them. And I talk about that in my book. I think this is easy enough to do that you can create your own portfolio. I also think the portfolio is stickier when you know what we just looked at about volatility, and you know what the up and down is going to be. You're much more likely to ride it out, right? Target date fund, and things go against you because you delegated this thing to a robot, and you really know how it works. You're much more likely to bail on the strategy. So I will always argue you're smart enough to put together a portfolio. You are smart enough to put together a portfolio. You don't need the robot. You don't need it at all. Robot does some other things that I don't like. They land the plane too soon. They get too conservative. You will sue them if they don't. You don't need to be as conservative as that is. So not a big fan of target date funds. And I actually said that on the Morningstar podcast, the long view. You can hear me go into that if you'd like on the long view podcast. Find that, and Christine and her co-host dive in that with me. All right, let's take a look at the next thing. So going to my comparison, the first thing I mentioned was what's the time frame, then which investment is less volatile. So if I have two funds that compete against each other, I certainly want to go with, if returns are even and one is less volatile than the other, I want to go with the less volatile one. So if I'm comparing two funds and I'm not sure which one to choose, and they do the same thing, they have a similar beta, they have a similar standard deviation, yet one gets there, they have different standard deviations. One has a lower one than the other. I'm going with the standard deviation. If I get the same return, but less up and down, I want to do that. So I don't blow up my plan. Next, after that, then we will finally now start looking at returns. So after we look at risk, then the next thing I do is I look at returns. So let's go over there. And I'm going to, let's pick somebody else's, because this bond fund is Eileen going to put you to sleep. Let's take a look at Rocky. We're going to do yours. ARAIX. Oh my goodness. So we have tried to get Mariel, Melody Hobson funds on our show, and she is so busy. Of course, her biggest claim to fame is that she's a phenomenal investor and a great person, does Good Morning America all the time. Of course, secondary thing. Anybody know the secondary thing about Melody Hobson? We talk about aerial funds. Here's some trivia. Why don't we do this? If somebody knows the other thing, non-finance related, first person to put it down, Melody Hobson is known for, put it there, and I will. I'll send you a copy of Stacked. I'll send you a copy of the book. I'm not going to wait for that. I'm going to keep moving on. It's just a slight delay. All right. The Ariel Fund. Of course, this is institutional because it's in your 4A. Institutional, this word at the end or the letters at the end, again, are just about how you pay fees. Chris got it. And I think Chris already has a copy of my book. Chris, do you know somebody that wants one? Do you have a library near you that might want one? I can send you one. You can use it as a holiday gift. That would be fantastic. So, well, nobody else said it. So the second person it then can go ahead and grab it. She's married to George Lucas. That's the other Melody Hobson piece. Okay. Yeah, what a power couple, huh? She's a phenomenal investor and all this stuff. Carol and I are having a lot of fun right now going through US Disney series, the Rogue One series, whatever that's called. Andor. Fantastic. Okay, Ariel Fund. Let's go back to risk here. Click over on risk. It says above average risk, average returns. Take a look at this. My beta, about 24% higher. Takes more risk than the category takes. Look at that. And then the standard deviation higher, 23.9. So this fund, the Ariel Fund, versus the one that Malcolm showed me, takes more risk. It's going to win more. But what's funny is it's rated higher. So how is this fund rated higher? Well, I'll tell you how. It's because of what it's competing against. This fund, and once again, novice investors compare everything to the S&P 500, and that is a huge mistake. This is a mid-sized fund, mid-sized value fund. And by the way, I can see that if I go back up to the chart, well, in the investment style, they even call it small value. Look up there. Excuse me. Look here in the upper left. It says small value in this Rubik's Cube. However, when you look at what it actually buys, so this is interesting. This is what it's owning now. Its stated thing is mid-size value, but it actually is invested in small value, right? Because what this shows is the intention, the investment style, and then what the risk shows is actually what they're in. And yeah, category mid-cap value. There it is, broad mid-cap value. So they're buying mid-sized companies that don't shake around a heck of a lot. But you can see shakes more because the whole category does than what Malcolm gave me earlier. So this is going to be more volatile. Notice now this one versus the index, with blue being the fund. It's to the right of the index, to the category by a long way, and it's a little bit lower. So you could have taken less risk buying the index and gotten better returns. Now, if you believe in Ariel funds and you believe in this active management, this is where the active man comes in, and you think next time they're going to beat it, you can go here. But OG, in my position on that is generally sticking closer to that index, because you can't predict who's going to do it, is a better game to play. And frankly, you are starting to play games when you start getting away from the index. But certainly here, what the game is. When Ariel Funds pops, it's going to pop bigger because of the additional risk it's taking. It's also going to lose a lot more money than the index loses, because it takes so much more risk. So it's going to go up and down a lot more. All right, let's go into performance, which is really what we want to see next. It's fun. Yes, Aaron, that does count. Nobody else put it. Nice job. So Aaron, send me an email, joe@stackingbenjamins.com, and give me your address, and I will send you the book. Okay. This is pretty neat. This shows the investments the past 10 years, how well this fund has done. And the first thing I look at is the top line, just point blank. How did the fund do? Because this gives me an idea, guys, about how risky this fund is in terms of putting my money here. Is it long term? Is it short term? So if all this style box stuff confuses you, if it's short term money, you want something that's barely ever going to lose money. If it's long term money, having something that goes up and down like this fund, we can already predict it, right? It's almost like a sommelier with wine. When I took this wine class, it was amazing by the end of the wine class. And I thought this was all just a bunch of voodoo. You sniff it, you look at the color, you do all this stuff. It got to the point that I kind of knew what it was going to taste like by the time I tasted it. And it wasn't always right, but it was really fun to go through all of this stuff. So by now, we already know, just looking at the risk numbers, that this fund's going to be all over the place. So I haven't even really spent much time looking. So let's do it. 10 years ago, it did 20.75. Then it popped up 45%, then up 11, down 3.7, up 15.8, up 16.2, down 13.4, up 25, down or up 10, up 30, and this year down 17. Any of that surprising? Not at all. Not at all. The second thing that I look at, now I could do the category and the index, the next two lines. How well did the average fund in this category do? And if you just bought the index fund, how well did the index do? And you'll see what we were talking about before, guys. In the up years, because it takes more risk, than the index, when the index went up 38, it went up 45. So if we're going to have a good year, Ariel, in most good years, is going to beat the index. Where's another eye-popping year? 25%. Guess what? The index did 27. So again, didn't perform the way that I had expected. But look at this, in 2021, up 30 versus 29. So 2 of the 3 years we had these huge numbers. Ariel beat the index. Third year, it didn't. That's the risk you take when you go with an actively managed fund versus going with an index fund. What I like looking at, though, is this quartile rank. When it comes to all the funds it competes against, which is really important, how does it compare performance-wise? Not risk-wise, performance-wise. So it's in the top 25%. So you see there's this like washboard with 4 parts. If it's in that top one, it's in the top 25, second 25, third 25, bottom 25. So in 2012, top 25. In fact, it gives you the actual percentage in the next line. So it was 14%. It was the top 3%, top 20%, top 55%, top 42, top 20, top 56, top 59, top 9, top 36. The fund that in some years is going to be this is also a fund that in some years is going to trail the index, but as you're seeing, not a ton. You see how we're coming up with the 3 stars that it gets? Because it generally does a pretty good job of doing what it does. This is a fund that takes more risk than what its competitors do. And 2 out of the 3 years that the market goes high, it pays. When the market goes lower, let's look specifically at those years. When the market goes lower, this is interesting. It's at 55% percentile, 56% percentile, and 59% percentile. 2 of these 3 are the years the market went down. So 2 of its 3 worst performances are when the market did poorly. This fund will underperform when the market goes down, overperform when the market goes up. 7 out of 10 years the market goes up, it'll be a good fund. I like the Ariel fund, but you can see how the index will probably do this more cheaply and more reasonably. And historically, it got there the same way. I'm just a big fan of Melody Hobson. I like what they do. And that's the problem of being a nerd. And by the way, back to the question we got earlier, which was all about the premium stuff. The premium stuff makes you even more of a nerd. And you end up like me going, oh, I know these people that run this fund and I know what they do and I know their stuff. And sometimes you know too much. And all I need is the numbers. The numbers on this fund says that I take more risk than the index takes, and I get a similar return to the index. So Rocky, if you have the Ariel fund and the index it competes against, which is going to be the small company value index, I would pick the small company value index over this fund, because that red dot, when it comes to the risk measures, this index. So again, left to right is risk, up down is returns. It's to the left, which means less risk. The blue dot real fund. It's left, which means it's less risk, and it's higher slightly. So the index is a better pick. Good stuff there. I don't know that I rethink that allocation. And well, Rocky, here's the deal. If you didn't realize that fund was a roller coaster ride, that's when you rethink your allocation, right? Maybe you want more roller coaster ride. Maybe you want less. I don't know. I don't know what the perfect allocation is to reach your goals, but that's certainly gives you some stuff to consider, some good stuff. All right. Once we've done that. So now guess what we haven't done, guys? The thing I hear the most about when it comes to this stuff is fees. It's 57 after. We've been here an hour. We have not yet talked about fees. Fees are relevant. We want to make sure that we pay less in fees, but there's so many people that own crap funds that don't get you where you want to go because they are cheaping themselves to nothing, right? You cannot shrink your way to greatness. You cannot. You have to choose a good first and then look at the fees. And certainly we can do that next. So let's dive in. If we go to price. So price tells me what the fees are. Now, this says minimum initial investment is $1 million. And Rocky, because you're buying it institutional, which means it's in your 401k, your company had to put $1 million in it, which means that you probably work at a fairly decent sized company that can put $1 million in, or they've worked out some type of an arrangement with Ariel to get in underneath that number. So don't worry about initial investment unless you're buying in your brokerage account. If you want to buy a fund in your brokerage account, your Roth IRA, whatever you're doing, then you got to look at the initial investment. This fund has no front end fee. It has no redemption load, and it has no deferred load. These are sales charges where if you buy them from an advisor, the advisor will sometimes charge these fees. So, Kevin, I love it. So this fund's going to have no what are called sales loads, no sales charges to buy it. The expense ratio is 0.69, which you can see in this blue, it's below average. So the dark green is a low fee. That next one is moderately low, below average, and then average, moderately high, right? And so you can see by the little blue box that's below average, that's where your fund is. So the Ariel fund is a fund that is not a deep discount fund, but it certainly is well below average at 0.69. And frankly, for a fund that is managed actively with a true active fund management team, that is an uncommon fee structure. And you'll see that on average, institutionals average 0.845, and this is 0.69. So the fees are definitely in line. Let's go back, by the way, to I want to go back to Malcolm's fund to show you the difference here. TRSAX. And these two funds don't compete against each other. This is large company growth, and Ariel is small company value. It's directly across. But look at this: above average fees, minimum investment $2,500. There is no front end, back end, no redemption loads or fees. This one has a 0.91 investment versus a 0.81. And this is probably another reason why this fund is 2 stars. So what we found already about Malcolm's fund is that it takes more risk, right? It takes more risk and gets lower returns. We know that the beta is higher. We know the standard deviation is higher than its category or the index. We haven't looked at it performance-wise, but performance-wise, we just did the things that we looked at before. This investment has spent some years in the top percentile, but look at this, 66, 64th. This last year, it's miserable, 93rd percentile. This makes me ask a question. What the hell happened this year? Suck and win so bad. And by the way, Malcolm, this also is interesting. So look at the performance before this year. Middling, but not horrible. 5 to 10, between 10 years out and 5 years out. Pretty respectable some of these years, 16, 12, 5, and 17. The last 5 years seems to be bad news. If this fund was recommended to you 7 or 8 years ago, they probably did a decent job of picking this fund. However, if they recommended it recently, that's not as great of a pick. And we go to the prices, by the way, for this one again, and the prices are higher. So returns over the last 5 years, prices higher, not that great. All right, guys. Guess what we did? We just went through the way that we evaluate a fund, and it's Malcolm. Your fund does blow. But you know what's cool? This is what's cool, Malcolm. You know it, right? Most people are walking around with these crappy funds. They don't know it. You know what yours is, and it's not that great. What I will tell you though, you're at T. Rowe Price. So generally, if you bought that through T. Rowe Price, you can look at T. Rowe Price's offerings, and every fund family has good funds and bad funds. And often you can easily exchange into a fund that is similar to, or excuse me, has a similar goal to that fund, or maybe you don't even want that type of thing. But you can look through T. Rowe Price's funds, find a different one, and without having to change brokerage accounts, without having to change your Roth IRA over to somebody filling out this paperwork, doing all this, messy stuff. If it's directly at T. Rowe Price, they've got a ton of good stuff there. And by the way, if you paid fees to get into the fund or to get out of the fund, and I'm going to show you guys that just before we leave, some of these funds that advisors use, what's his name? What's his name? That's funny. Dave Ramsey. Dave Ramsey, big fan of American funds, right? American funds AMCAP. American funds have a fantastic performance history as a group. This fund, not so much. But we take a look, we go first to risk. AMCAP takes a little less risk, 3% risk. Standard deviation 20 versus 23. So it's actually going to, this fund's going to do really nicely in down markets. It's a pretty decent fund to own now, which you'll see historically over time. That blue dot now to the left of the index, it gets a lower return, but is it worth it? If you're a conservative investor, this might be a good fund in terms of what it competes against. This is large growth. So this competes, Malcolm, directly against your fund. And look at the